Hi Gaurav, how are you?
Yeah, hi, I'm good. How are you?
Good. So Gaurav, we are hosting this on two platforms. One is on Zoom and other is on YouTube.
Okay,
So apart from having participants over here, we will be having audience on YouTube also.
okay.
Start with your introduction. So Wealthy Nivesh is very proud to have you with us. Thank you for spending time for us on a Friday. Gaurav handles banking and financial mutual fund with Mirae Assets, and he has got around a decade of experience as an analyst and as a fund manager. The topic that we are going to dwell upon today is global interest rates and banking sector outlook. So, Gaurav, our expectation would be you could just give us a brief about how interest rates are mapping up not only in India but global markets also, in American and European markets, and how they can affect us both on investor side and as a loan taker. So if I am taking some borrowing, what is the implication of Fed raising rates in America on my rates? Over to you, and post that we can have some question Q&A session. Is that fine with you, Gaurav?
Yeah, yeah.
Yeah,
Can you
Gaurav,
hear me?
I can hear you.
Sure. Thanks a lot, Ankit, for the introduction, and thank you for inviting me on this discussion. So, yes, I mean, a brief about the global interest rate scenario. We all are grappling with, the higher interest rates that we've seen in the last 18 months or so. If I were to look at, the pre-COVID scenario where interest rates were, almost zero at US, we're talking about 1.5 to 2% kind of inflation. The economy was doing all right. And if I compare that to India, we were operating at 5.5, 5.75 kind of repo, and our inflation was within the target range of RBI, which was around 4 to 5%. So that has considerably changed post-COVID because there was a lot of liquidity which was infused globally. Starting with Fed, who expanded their balance sheets, continued in Europe, in UK, and it happened across the board. If I were to, call out India's strategy, I mean, we have been little more, prudent in that form. RBI has not, in terms of, the excess liquidity, while there was excess liquidity in the system, but it wasn't created by the central bank. So to speak, in India versus what was the case in other economies, and as a result, the pinch of inflation was much higher for the US, UK, Europe, etc. So their economies suffered a lot of inflation because of that, which led to inflation even reaching double digits in UK, a high of 8% in US, which was unheard of about a decade back. So that led to Fed tightening the overall environment, and the interest rates hike were very sharp. Almost, if I talk about it, there was a 500 plus basis point increase in the last 18 months from Fed. Likewise in UK, which the quantum is something that we have heard of only post the GFC, when the price hike happened. So I think if I were to look at what led to this, as I mentioned clearly, it was inflation. And if I look at the incremental data, which has come month on month, the inflation seems to be easing a bit. You look at UK or US. UK is still high, relatively, but it's tapering down, and that's a good sign. Fed has also kind of not signaled, but indicated that we could be near the peak, if not the peak of interest rate cycle. And incrementally, if the inflation print continues to remain lower than sort of expectations, then I think that could lead to interest rate cuts also starting sooner rather than later. So I think it all depends on how the inflation print comes. Even if I look at the core inflation and not the headline inflation, the core inflation also is around 4% now, which used to be 150 to 200 basis point lower in the pre-COVID scenario. So we need to see inflation print below 2% at a headline level, and maybe 250 basis point at a core level for us to get comfort on the interest rate would start to taper down. So for now, I think we are at the nearly at the peak, I would say, and how fast we get to lower inflation environment is where my sense is that the rates will start to taper down. If I look at India in that context, we have done a 250 basis point rate hike in the last 18 months. In context, I mean, as I mentioned, UK and US have been 500 plus. So we've been relatively more paused and more gradual in our rate hikes. A little more prudent, I would say. That is precisely because the inflation hit to us has not been as sharp. Our inflation used to be 4.5%, 5% pre-COVID. We went up to 7.5%, during 2022, and now it is normalized to 4.5%, 5% again. And the RBI's tolerance limit is in that 4-5% band. So we are broadly there. So our peak also, I believe, is we have been in a pause mode for some time, and I think that should continue. But all this while, what has happened is the differential between the US rates and India rates. If I were to look at the Fed rates and our repo rate, the difference used to be 300 to 400 basis point prior to COVID. That difference is now narrowed down to just 100 basis point, and clearly that cannot sustain because it has long-term repercussions on currency outflows, etc. There is a currency risk inherently, and there is a risk of money flowing out, which has been happening in India. If you look at it, the FPI flows, etc., has been negative over the last few months. So I think once the Fed starts to taper down on rates, India would probably go a bit slow. The rate cuts will not be as sharp because rate hikes were not sharp. So to that extent, I think that gap of 250 to 300 basis point is where it should settle eventually. It's a complete cycle where you had higher interest rate environment, lower interest rate environment. You're back to that higher to mid moderate, and now I think you'll taper back to that normalized interest rate environment. So I think that the differential of 300 basis point should kind of in the next 1 or 2 years we should see that happen again, which means that the rate cuts in the US would be much sharper, and it would be a little more gradual in India. So maybe we are talking about first reaching the 5.5% repo rate where we were pre-COVID, and from there on taking on how the Fed decides to cut the rates. In as far as if I look at the overall impact, as Ankit pointed out, what could be the impact for us? One thing that RBI has done in the recent past is they have asked banks to link their loan to repo rates. So we see our housing loan, and most of the retail loans, including car loan, etc., has been linked to repo rate, which means that whatever repo rate cuts that the RBI does, that same gets transmitted and benefits the end user, the end consumer. So if I were to draw your attention to what used to happen in the past, we had a base rate regime where banks controlled the base rate, wherein that did not change when the rates went down. So the benefit of the rate cuts, could not be passed on to the consumer. Next, we moved on to MCLR, which was marginal cost of, lending for the banks. There clearly, the funding cost did come down a bit. So the marginal cost or MCLR rate did come down a bit, but the transmission was not to the same extent. But now what RBI has done is directly linked to an external benchmark rate where banks have no control. So while MCLR and base rate were controlled by bank and they could, reprice those rates manually, this is more RBI direction. And if let's say repo rate goes down by 100 basis point, the same will be reflected in the interest rate that is charged to the end consumer. So I think that is the kind of transparency RBI has made very clear. So that should, whenever we start to see the rate cuts, I think the interest rates will go down for the end user. Likewise, for we see bond market borrowing, etc. All of that will also see some bit of softening. If you look at the bond deals, bond deals have softened a bit in the last month or so. With the probability that Fed might pause, and once Fed starts to cut the rates, we can see some bit of normalization in bond deals, and we probably go below 7 towards the end of March. Is where our guess is. So I think whenever the interest rate starts to come down, globally it has an impact on India. It will also have an impact on borrowings, the retail borrowings that we do. It will have overall cost of funds coming down for both individuals as well as corporates. But that is some time away. As I mentioned, that the inflation print needs to come down to maybe more normalized 2.5% kind of number in US, which is currently 3.2, and the core is currently 4. And in India, we are at around just about 5 and thereabouts. We should come down to 4 before we see all of that translating. So that was on the interest rate bit. If I move to sector, I think very topical. RBI had come up with a circular yesterday, regarding unsecured credit, increasing risk weight. So I'll just talk about it very briefly, just so that the audience is also aware of what the new what is the new subject that RBI has introduced. So here I would draw your attention to 2019 circular, wherein the risk weights were reduced from 125 to 100 on personal loans. So this is just a that 100 is now taken back to 125. So earlier you look at 5-7 years back, banks were operating unsecured credit at 125% risk weight, which was reduced to 2019 because we saw some slowdown in consumption in those years, and government wanted to take steps to improve consumption. And one of the form they thought would be to improve the consumer credit. And as a result, they reduced the risk weight to 100. Now they're seeing some bit of stress developing in the system, mainly in the small ticket loans. But as I mentioned, RBI do not differentiate between a small ticket and a large ticket. For them, unsecured is unsecured, and today the stress might be in the lower ticket segment. But who knows tomorrow if it translates or transcends into a higher ticket loan also. They don't want to take that kind of risk. So they've classified all unsecured personal loans with the same sort of risk weight, and they've increased that to 125 back again. So what this will do is maybe at a headline level, the kind of growth we saw in the personal loan portfolio, especially the unsecured loan by fintechs, by small NBFCs, by large NBFCs, all of them, you used to be growing at 30% plus at a system level. At an aggregate PL portfolio was growing north of 30%. Now we can see some bit of moderation in growth because now the cost of money is getting dearer, the capital requirements are higher. So you might want to slow down a bit on the growth. So what this will do is this will curb down growth. And whenever we see the growth coming down, the small and the marginal players are the ones which are most impacted. This may not impact the large banks, this may not impact the large NBFCs, but the smaller ones will see a bit of pressure on growth. We'll see more capital drawdown. We'll see more, increase in their cost of funds. So this will what this will do is this will probably open the floor for the large banks to gain some market share while the industry slows down. So this is how we see it in terms of what this RBI circular means. It's a welcome step because there has been a lot of growth, and we don't know next leg of NPA cycle whenever it comes. It could be in the retail cycle, and as we understand, the retail unsecured piece is one that is the worst hit whenever there is a down cycle. So just to be a little cautious, RBI has probably taken this step, which we believe is very prudent in the current scheme of things. Coming to Ankit.
So I have one question over here. So RBI has mentioned that they're very concerned about the stress in retail loan book.
Yes.
So is it more of preemptive step or it's more of a corrective step? Means is there already in the system, or they are just trying to be proactive so that it doesn't build up in the system?
I think this is more a preempting or proactive step, because if you look at the system data, other than ticket size of less than 50,000 crore, ticket size of less than 50,000, personal loan with ticket size of less than 50,000, the stress is minimal. The delinquency levels have only increased in that bucket, and that bucket predominantly is operated by fintechs. If I look at banks' personal loan NPA, be it the large banks or mid-sized banks, the personal loan NPAs have been reducing or have been stable. They've not increased, and no bank has sounded cautious on the delinquency rising in the personal loan space. There has been some delinquency in the credit card book, but not so much in the personal loan space. And if I were to look at the overall industry size, it's north of 10 trillion rupees. And large part of that is banks. Almost 80-85% of that is banks. And they are not seeing any stress. So at a broader industry aggregate level, the stress is not much. But if you split and dice it into small buckets, maybe the 50,000 ticket size or less than 25,000 ticket size, the BNPL segment and the likes, you will see some stress. If you increase a bit and say the credit card book, there is some stress. But on the larger ticket and what banks does, the 5 lakh loan plus, that seems to be doing quite well. So yes, in certain pockets the stress has gone up, and maybe that is the reason why RBI is just being proactive and assuming that nothing happens on the larger ticket, or this does not have a cascading effect on the overall portfolio. They just want to curb the growth down a bit.
Gaurav, for the benefit of our audience, can you dwell upon a little bit on regulatory arbitrage between NBFC and banks? And I think even among NBFCs, there is different set of regulation for big NBFCs and small NBFCs. So So if you could just help us understanding that arbitrage and how it affects business and the kind of target audience that we have.
Sure.
Maybe in some examples also like Shriram, etc. and those.
Sure. So I'll just talk about the regulatory arbitrage now, what it exists. So it's reduced a bit, reduced a lot in fact, but there's still some arbitrage because NBFCs are they don't have CRR requirement. So banks typically have a CRR requirement. So roughly of the 100 rupee deposit that you have on the liability side, 4.5 rupees goes to cash reserve ratio to maintain the CRR with the RBI. There is an 18.5%. So 18.5 rupees goes to SLR. So typically that 23 rupees is sidelined and you are left with 77 rupees, to lend. Whereas in case of NBFCs, let's say of that 100, there is no CRR. SLR is only limited to deposits that you have. So let's say of the 100 rupee, only 20 rupees deposit. So on that 20, you will keep the SLR, which is required. So maybe you keep 4 rupees as SLR. And the remaining 96 is something that you can lend. So clearly versus the 77 rupee, which is open to lending, there is a 96 rupees for NBFC to lending. So that is one clear arbitrage which exists for NBFC and it will continue to exist even after the upper layer norms have come unless RBI changes something. The other bit, look at the PSL requirement. So for banks, on the loan side, of that 77 rupees which is available to lend, 40% has to go into priority sector. So that 40% is, and within 40 there is caps. There are caps on small and marginal farmers. There are caps on MSME. There are caps there. So overall, it has to be 40. Whereas for NBFC, there is no such restrictions. So that 96, they can freely lend to where they want to lend. And there are product-wise NBFCs. They can do gold. They can do consumer loans. They can do housing, etc. So that regulatory gap. This is the largest beneficial for banks. There is a liquidity coverage ratio, LCR we call it. So banks have to keep 100% of liquidity for all the outflow that the bank sees in the next 30 days. So for them, because deposits do not have a maturity, if you look at your savings account or your current account, there is no deposit, there is no sort of tenure, fixed tenure. You can withdraw it tomorrow, you can not, you may withdraw it a year later, you may withdraw it 5 years later. So for that, there is a calculation that RBI gives, and based on that, you have to maintain some liquidity coverage ratio. Whereas for NBFC, most of the borrowings are tenor based. So you will have exact repayment amount, what is there. There is no CASA, there is no float. So what you have is the 30 days, next 30 days, what is the outflow, a static number. And that on that you have to keep some liquidity, which is much lower than banks. So for RBI, by December 24, you will have the peak LCR requirement of 100%. Till now it was 40, 60, 80, and now it will go to 100 in December 24 next year. So I think that is the other regulatory arbitrage for NBFC versus a bank. I think these are the 2-3 examples that I can think of. And there is leverage, NBFCs, leverage cap for NBFCs, which was there for banks also. The tier 1 has increased a bit. The requirement of tier 1 has increased a bit for NBFCs also.
Great. Gaurav, my next question is about Mudra Loan. So there has been some talk going on for last 2-3 years that there is a lot of stress building in Mudra loans specifically. Mm-hmm. So Mudra loans are without any collateral given to anybody basis their Aadhaar card, 10-15 lakhs for making people dependent, self-employed, etc. So what are your views on the same? So is this just a naysayer chatter or it means anything?
Sure. So I think Mudra Loan is something that has been also classified as Mudra Loan. So a lot of MSME loans that banks do, a lot of microfinance loans that banks do qualify as Mudra Loan. If you look at the core Mudra scheme and the loans which are given in that scheme, under that scheme, and if I look at the classification of Mudra, I think large part of that is, the MSME loans being classified as Mudra loans. And the stress seems to be high. If you look at the nature of, the MSME loan that we have, the agri loan, MSME loan, etc., we used to operate at double-digit NPAs in this segment. Even in the past, if you look at last 5 years, FY 16, 17, 18, we were at maybe 12% kind of agri NPA, 12% kind of MSME NPA. And now, if you look at the numbers, it's in mid-single digit, right? Agri NPAs and the MSME NPAs are down to 5-6%. So that clearly indicates that the stress has improved. We used to run at a higher NPA level, the credit cost used to be high, but now it seems to be tapering off a bit. So whether 5% is high, maybe yes, but it has come off by a big margin of what it used to be. There's a lot more discipline in banks, lending, underwriting, etc. With GST, etc., a lot of data has also come into the picture, which earlier were not there. So I think all of this put together is helping reduce stress. And incrementally, I think the NPA levels that we are operating at today in Mudra loans or in MSME loans will only come down from here.
So, Gaurav, two follow-up questions on this. First, is this, coming down of NPA is coming at the cost of lesser dispersal? First, and second, don't you think lower double digit is the kind of NPA that anyhow we should expect in such kind of, loan scheme, which is more for social benefit, which is without any due diligence, which is more for, helping people at the bottom of the pyramid. Looking at how these kind of things work worldwide in microfinance and all kind of segments.
Right. So first part of your question, whether this has come at a cost of dispersal, lower dispersal, no. If you look at the MSME piece, it has been growing quite well for all the banks. If you look at the business banking loans, MSME loans that banks classify, sorry. If you look at the MSME loans that NBFCs do, we've seen a very steady growth in MSME loans since the onset of GST. In the last 4-5 years, we've seen incredible growth in this segment. And if I look at the NPLs, they've come down significantly. So there is an old book which is lying, and there is a new book that is formed. If I were to split this into two halves, the back book NPAs are still there, whereas in the new book, the NPA formation is much lower. So on an incremental basis, we may be operating in a very low single-digit number, 2-3% kind of NPA. I'm just hazarding a guess here that on the incremental book we might be running only 2-3% NPA, but on the back book we might still be at 6-7% NPA. And on a blended basis, now we're talking about maybe a 4-5% NPA. So which means that the quality of new customers acquisition, the quality of the new book that is getting built with the presence of data, GST, etc., is much better across the board. So that is helping, that. And second part of the question lies in this answer that, since the incremental book is coming, at lower NPA, I think it's reasonable to expect the NPAs to be much lower than what it were in the past. I don't see why should, banks be okay at 12% NPA or accept that, an NPA level of 10% or 12% is okay. I think those days are behind. We're in a good credit cycle. Till the time we are in a good credit cycle in terms of GDP growth, overall credit offtake, utilization of limits. Till that time, we see, at least in the next 2 to 3 years, I don't see that coming off, both on the corporate side or on the MSME side. It's a very economy-driven kind of sector, and till so long as the economy does well, I think these are the sort of micro indicators, as we call it, for the economy strength. So, and if we are believing in the story of the 5 trillion GDP and being the third largest economy by 2030 or maybe before that, I think these are the pillars of the economy, the micro MSMEs, etc. So I think these should augur well for the next 3 to 5 years at least.
So that reminds me, typically it is said that banking grows at 2 times of GDP growth rate. So that way, anyhow, banking should grow. And you also mentioned about formalization of economy, how it's helping banking. So I think that's another, good trend looking from the side of banking. Gaurav, if you could just take us through the journey of NCLT since its inception, since IBC. I remember there were 12 players who were admitted under NCLT when it was formed and all. I think 20 players with 12 lakh crore worth of NPAs. Yes. And the latest data says that right now the haircut that banks are having is 45%. So if you could just give us a detailed review on how NCLT has rolled out, how it has performed as compared to SARFAESI and previous kind of setups, that would be very helpful.
Sure. So I think the best part about NCLT and IBPC has been fast tracking resolution. So a resolutional professional is assigned, and there is a timeline attached to when the account should be resolved. And if not, nothing happens, then it has to be liquidated. And another good part is that lenders have a say in this. Lenders can form a union and decide on what kind of recovery rate they should get. And what we are seeing is incrementally. If I'll just quote power assets as an example, because a lot of NPAs in the previous corporate cycle happened in the power and infra space. So those assets which turned NPA during the FY13 to FY15 phase, we are seeing strong resolutions happening now. with the help of NCLT, IBC, the recovery rate, as you mentioned, has improved to 45%. If I were to, calculate a similar number in back in 2012, 2013, before the IBC, before the NCLT, we were talking about, maybe a mid-20s kind of recovery rate. So recovery rate across, SARFAESI, then followed by the CDR mechanism or the S4A mechanism, whatever we used to do earlier. Those recovery rates have clearly improved to 45%. And what we are seeing incrementally, at least in the power sector space, where we still see large ticket resolution, the recovery rate is as high as 50-60% also. So it again is dependent on the assets, the timing, etc. But a formalized fast track resolution mechanism, which is what NCLT is, does help in the recovery, percentage terms, the recovery percentage, because there is a procedure to be followed. There are the do's and don'ts in case of IBC, in case of NCLT, which helps bring the process a little quicker. So clearly, it's reflecting in banks' recovery rate in terms of whatever resolution happens. We're getting maybe a 40 cents to a dollar, 50 cents to a dollar versus 20 cents in the past.
Great. And Gaurav, so recently a lot of global indexes has increased India's contribution, India's exposure to their index. So will it affect banking in same proportion, or banking will benefit more? Because typically banking has more FII exposure, etc.
Sure. I'm not an expert in index or the technical side of things, but definitely we are seeing as markets do well, as Indian markets do well, and if I just correlate to the Indian economy is doing well, it's standing out amidst maybe in terms of growth, in terms of stability. So that is kind of reflecting in India's weight moving up in various other indices, and that will continue so long as the earnings growth momentum is there, because ultimately index is a representation of multiple stocks, and multiple stocks are a reflection of the underlying earnings, the strength of underlying earnings. And till that exists and that persists, I think we can see good move in overall markets. Talking specifically about BFSI, yes, FIIs definitely it's a sector where FII do invest. So far, if I look at the overall flows in FIIs have been net sellers. But having said that, whenever the FII flow do come, maybe a large chunk definitely comes in the banking space, in the BFSI space. So yeah, maybe whenever that comes, I can't guess when will that come, but whenever that comes, it definitely has a positive sort of impact on BFSI sector.
We got one question on YouTube channel. The audience is asking, what can we learn from Turkey's interest rate blunder and inflation, and what are there any implications of it for India as well?
Sure. I think India has been, as I mentioned, that we've been a lot more prudent in rising both on the rates moving up, and whilst cutting the rates also, we were very very prudent in that sense. And if I look at the inflation data as a result, the differential between what I explained in US, UK, etc., and what's happened in India, we've been a lot more balanced, and the impact has been at around 7.5%, 7.8% as peak inflation versus the normalized 4% kind of number that we had. So clearly, I think RBI has been doing the right things. Even if I look at the way they handle stress during COVID, be it in the form of the dispensation, regulatory dispensation on loans, there was no cash given, there was no cash disbursal, so to speak. There was no waiver as such. So, and that's why you see a lot of resilience in the balance sheet of banks, because there is a process to be followed, and RBI appreciates banks following that process. So there was a restructuring mandate that was given. There was certain dispensation given in the form of ECLGS, the credit guarantee scheme, etc. So which helped banks, which helped the MSMEs recoup whatever losses they made in the business. Giving them some time, some working capital, some leeway to make the payment. That clearly helped them, the MSMEs and others, which I think was a differentiator between our economy and others. So I mean, kudos to RBI and the government. I think they've been doing the right things. Touch wood, and hopefully they'll continue to do the same.
So Gaurav, one comparative question. So in the last 20 years, we have seen two major global crises. One was 2008 crisis, and second was this one. in both crises, we had very heightened fiscal deficit. So, if I remember correctly, in 2008, our fiscal deficit overnight went from 3.8 to 8%. And even this time, government, very justified one, very explained one, had to take up our fiscal deficit to very high levels.
Right.
But in 2008, after a lag of 1 or 2 years, the inflation became double digit.
Right.
So how do you think, is it a risk that is there again? Or do you think because of, fiscal and monetary policies this time, this risk is mitigated?
Yeah, I think one of the biggest factors has been the collections. If you look at the GST collections month on month, the kind of strength we are seeing there, that's phenomenal. And as you mentioned, I think the credit loosening cycle in the previous instance was a credit loosening cycle in this instance has been more calibrated. So to that extent, the impact of inflation has been rather less. And the pace at which we reduce the interest rate from here on also holds the key as to where an inflation could land in the next 2 years or so. In terms of fiscal, I think the balance sheet has been managed quite well so far by finance ministry. And if I were to talk about the collections, have been very resilient. I think that's been the key differentiator. Back then, we did not have this kind of tax collections. This time around, we do see that helping overall fiscal situation in the country.
So, do you think this increase in GST will continue from here on, or it's more of like we have seen the exceptional growth, and now it will be more of a stable kind of growth from here on?
Sure. So I think part of this could also be attributed to formalization of the economy. That has played its part in GST numbers improving. From here on, again, it's going to be linked with how the economy does. Overall pickup in consumption, overall pickup in economic activity. That is where I think the GDP, where the GST growth should be. We are in that phase of 1.6, 1.7 kind of a number every month. Probably we should see a stable kind of increase from here on.
And what is your take on inflation in coming years? Do you think that from here on it will soften only, or there will be again sine waves or cost waves?
I think a lot of moving parts to it. One is the commodity inflation, which is a very hard one to predict because it's driven by global outcomes. The macroeconomic situation is evolving. You see, Russia-Ukraine conflict followed by now what's happening in the Middle East, etc. So a lot of moving parts to it. So it's very hard to take a call on where the inflation could be. Pure play, interest rate scenario is where everything lies. How we ease our interest rate environment is also very crucial as to how inflation could pan out. So a lot of moving parts to it. Hard to take a guess, but hopefully the peak is behind. Maybe whatever peak we saw in 2022, that is the peak hopefully, and we could see some bit of movement here and there. But broadly, we should be in that RBI's ballpark of 4 to 6% kind of inflation, which is their tolerable limit. I think we should be around that most of the time, barring a few hiccups or barring a few instances where it could be a little volatile.
So, Gaurav, I'm sure you will be getting this question a lot these days. How can general election of 24 can roll out for the markets?
So I think again, very tough to say what could pan out for the markets. But in general, what we've seen is any government that comes, a stable government, has a positive bearing on the market because there is a stability, in the policies and the reforms that whatever the government has done, and that continues. There is a positive sort of linkages to that. Beyond that, I think market will definitely absorb whatever the mandate is. Whenever the elections happen.
Do you think the ongoing 5-state election can have an implication on the markets in short term?
I think short-term volatility can be there because of elections, whatever outcomes come from the multiple states that we're talking about. But those can't be, read or extrapolated. I think for long, the Indian economy is doing well. And what we need to understand is the individual companies which form the index, the earnings growth of those is not linked or is not related to the state elections to a large extent. So to that extent, so long as the earnings growth momentum is strong for the next 2-3 years, there could be some volatility in the market, but broadly speaking, in a 2-year time frame or a 3-year time frame, these things will not really matter. What will matter is how the underlying growth, underlying earnings momentum is, and if that is good, then the markets will definitely do well, irrespective of whatever happens in the state elections, etc. Those could be the near-term sort of volatility in markets.
So, Gaurav, if I have to start my portfolio from zero, and assuming that I am somebody who have a horizon of 4-5 years, then and I would like you to answer this question looking from the point of view of a very layman investor, somebody who just want to invest into mutual funds. So how would you advise that person in today's time to build his portfolio?
I think it all depends on the risk appetite and the kind of exposure that the person is willing to take. Honestly, 4 to 5 years is the right kind of outlook. If I were to invest in mutual fund in any industry, there is a cycle that we are investing. I'll talk about BFSI because I come from that background. So in a BFSI, typically, the cycles are long. We had a NPA cycle which lasted for 3-4 years. We had a good credit cycle before that; it lasted for 3-4 years. So typically, in a BFSI, a full cycle to play out takes about 3 to 5 years. So in that there could be some ups and downs because of macros, because of regulators, etc. But that giving that 5-year full time frame to the sector is most important. I think as an investor, I need to be disciplined enough. I cannot take, if my outlook is 4-5 years, I should not be concerned about maybe a short-term volatility in the markets, which may happen on account of, as you mentioned, election, which may happen because of some temporary blip in inflation, etc. So I think handling that volatility, being disciplined about investment is the first sort of important thing in any investment, be it BFSI sector or any other sector that is invested in.
And do you think right now, a staggered approach will make more sense than going for lump sum approach?
I think in a 5-year time frame, staggered lump sum, it all evens out, is my view. I mean, best is SIP, but if one has the liquidity today and wants to deploy 5 years horizon, I think staggered or immediate deployment lump sum doesn't make much of a difference. But the ideal way would be to keep investing in bit by bit every month. That also captures some bit of volatility, some bit of investment at a time when markets are down, which we saw even during COVID. So if you do a pre-COVID to now kind of what a SIP return versus pre-COVID to now lump sum, you'd find maybe SIP did reasonably well.
Okay, Gaurav, when you and me were in a school, we used to listen to when FII sneeze, markets get cold in India. Right. And now we have scenarios when, last 3-4 years, even before Corona, FIIs had been pulling out money and still markets are going up. So my understanding is it's because we have got SIP book, we have got EPF book, we have got NPS book. So what are your views on the same? So is it right to say that now we have counterweight to FIIs for Indian markets?
Yeah, thanks. So here, I think it's clearly aided by a lot of people getting educated about markets, a lot of investments coming into the market, and thanks to people like you and your organization, which is helping understand people the importance of capital market in the country, the power of equities, the power of overall sort of mutual fund investments, etc. Clearly articulated by both AMFI and the regulator, which has been doing a lot of marketing activities to make sure people are aware about this. So that has helped a lot of flows coming into the market. Today we talk about proudly talk about 16,000 crore plus number on a monthly basis coming in the form of SIP, plus there are a lot of lump sum investment, etc. So all this definitely has increased. If you look at the mutual fund AUM as a percentage of GDP, it's been growing, right? We were talking about back in the days you mentioned, we were talking about a single digit number from mutual fund as a percentage of GDP, and that number is growing in double digits every year. So I think there's a lot of heart to it. A lot of people have put their hard-earned money. It's a very fiduciary kind of a responsibility for us also to invest. And I think we take pride in saying that India as a growing economy, mutual fund industry is still underpenetrated, despite whatever you mentioned, whatever we spoke about. There's still a lot of penetration still to come, a lot of money from tier 3, tier 4 cities and beyond yet to come to the markets. It is coming, it is growing, but I think there's a lot more to the industry than what we are seeing today. So hopefully this theme will continue to play out, and as it happens, probably the effect of FII or any foreign money will get neutralized to that extent, which has been the case in the last 5 years. As you mentioned, the share of FII has been lower today versus what it was 5 years back. Still, the markets are holding up, which may not have been the case, when maybe 10-15 years back when we looked at the market. So yeah, thanks to the investors and the patience that they've shown in markets.
So Gaurav, I'm so glad you mentioned about fiduciary duty. And unfortunately, in India, we don't have much awareness about it. So for the benefit of audience, I'll dwell upon it. Fiduciary duty means that if I am your distributor, if I am your mutual fund distributor, then even without any proper, agreement or any proper, even any explicit mention of the same, I have fiduciary duty towards your money. So, and again, you mentioned pride also. We also take huge pride in the fact that at such a young age, people like Gaurav and Ankit, manage people's lifelong savings. So that only increase our responsibility part. About the mutual fund penetration, when we were building the business idea for, Wealth Innovation, we have been in business for 1 year only now. So when we were building the numbers, so before Corona, the number of mutual fund investors were only 10 or 15 lakhs, 10 or 15 million.
Yes.
To 1 to 1.5 crore. After Corona, it came up to 25 million.
Yeah.
And now it's up to 40 million.
Yes.
Against that, the number of Dream 11 investors in India is 110 million. The number of active crypto again investors in India is 70 million. And even if ideally this ratio should be other way around. The number of so-called investors in crypto and Dream 11 should be less than mutual fund in a mature market, but that's not how it is. And even if you don't look at this relative comparison, there should be at least 10 to 15% of the population investing into mutual funds. Right now, it's only 3%. So I think for mutual fund industry, the market potential is still very high. But Gaurav, that brings me to my last question. Do you think this supply side from the from the side of investors, is it going to form a bubble, or do you think markets have enough appetite to absorb all this money? Take a scenario where FIIs also say that now we want to invest in India, full throttle, and Indian investors are also investing. Do you think market has got appetite for that kind of money?
Yeah, absolutely. I think if you look at the market capital itself, market cap to GDP, etc., that seems to be going up. We see more and more listings, new listings coming up, every year. Be it on the SME side or be it on the overall exchanges. So new listings also, come up with some sort of market cap which can be invested by mutual fund. So clearly there is a lot of appetite even within existing stocks. And there will be more companies that will get listed, more companies that will come up for initial public offering, etc. So the appetite is pretty much there. Whenever the money comes from FIIs or DIIs. So the bubble piece is dependent on a couple of things here. That it could be a situation where a flow-based bubble we've seen in the past also, but it may not sustain, because ultimately price is going to be, as I mentioned, it's a very boring line, but I keep mentioning it. It's on the performance of the company, how the overall earnings growth trajectory builds in. So maybe for a temporary phase you can have that bubble, but that bubble cannot last forever. Underlying earnings has to pave the way for the valuations to remain rich. Otherwise, we'll see some bit of normalization also. So I think if I look at the overall the PE ratio or etc., it's quite reasonable even after the run-up that we've seen in the last 6 months or so. Can it build a bubble? Maybe it depends on what kind of flows we get. But if I look at the broader trend in the last 2-3 years, the market has been absorbing whatever increase that we've seen in the flows towards equities, that has been easily absorbed by the market, and we have not seen any sort of bubble build up in the last 3 years. So I expect similar things in the next 3 to 5 years. Even if the flows come, I believe the market will have that kind of appetite to absorb whatever funds we get.
Yeah, I think now that P is more or less equal to long-term average of 5 years and 10 years. So, we can keep these discussions of bubble valuations to rest. Thank you, Gaurav. Thanks a lot. So even though we do this session on a weekly basis for our clients and general audience at large, but I don't remember any other session where we dwelled upon on so many topics in such a concise and in such an informative manner. Thanks a lot for being here. Really loved talking to you. Thanks a lot.
Thanks, Ankit. Thanks for calling me. Thanks for inviting. Even I had a very good discussion. Thank you.
And thank you everybody for attending. We will be shortly hosting it again on YouTube. So look forward to having you guys over there also. Thank you.
Thank you.